Welcome to today's Explainer, where we're cutting straight through the noise to give you a definitive, research-backed framework for evaluating AI stocks as we head into the second half of 2026. Look, if you've been watching the markets at all, you know the AI landscape is shifting incredibly fast. We are way past that initial hype cycle now, and we're entering a massive phase of real, tangible monetization. So let's dive into the data together and figure out exactly where the smart money is actually heading. Okay, let's quickly breeze through our roadmap for today. We'll start with the 2026 AI boom, then move into our rankings. The S-tier elite plays, A-tier strong contenders, B-tier stocks worth watching, and the dreaded avoid tier. Finally, we'll wrap it all up with a winning AI portfolio strategy. Section 1. The 2026 AI boom. Let's look at exactly how this market is making that crucial pivot from sheer hype to actual monetization. We're starting with the broader narrative of this 2026 gold rush because here's the thing. The AI boom isn't slowing down at all. It's just fundamentally evolving. We're talking hundreds of billions of dollars pouring directly into infrastructure, custom silicon, and inference compute. That's the processing power you need to actually run these AI models once they're trained. The sheer scale of hyperscaler AI spend is completely dwarfing general traditional IT sectors. Literally, the cumulative infrastructure spend is forecasted in the trillions. It's just staggering. And because enterprise adoption is accelerating at such a breakneck pace, you have to understand that not all AI stocks are created equal in this mature phase. The big divergence is happening right now. You've got some companies offering sustainable growth, real margins, and even dividends, while others, well, they're really just overhyped speculative traps. Moving to Section 2, the S tier, the elite plays. These are our absolute highest conviction buys, the real pinnacle of the market. So NVIDIA absolutely anchors this list. Trading around the $214 to $222 mark with a market cap blowing past $5 trillion, they are the undisputed king. And their moat is exactly why they're S tier. With their next-generation Blackwell chips in full ramp-up and the Rubin architecture on the horizon, they aren't just selling individual chips anymore. Between their CUDA software, GPUs, and networking, they're basically selling an entire unassailable ecosystem that hyperscalers literally cannot live without. Just to ground this in reality for a second, analysts are projecting over $250 billion in revenue for fiscal year 2027. Let that number sink in. When you combine that with 50 to 70% EPS growth in key periods and elite gross margins hovering right around 75%, their 24 to 33x forward earnings multiple actually looks incredibly reasonable compared to their historical averages. They even pay a small, growing dividend now. This is the ultimate pick and shovel leader, hands down. Next up in the S tier, we have Microsoft, currently trading around $427. Microsoft is fascinating because they perfectly balance infrastructure with application layer AI. They are essentially a platform monetization machine. Azure growth has reaccelerated into the high 30% range, largely because it's the absolute preferred cloud for OpenAI workloads. They're taking all that AI hype and churning it into reliable, sticky, recurring revenue across the entire enterprise sector. Driven by their brilliantly structured 27% stake in OpenAI, which gives them massive upside exposure without holding all the risk, and their rapidly scaling enterprise copilot monetization, their fiscal year 2026 revenue guidance is pointing toward a massive $327 billion territory. Microsoft is offering 15 to 20% earnings growth potential at a very reasonable 21x forward multiple. Add in a consistent dividend yield, and it's a fantastic lower volatility way to play the S tier. Alphabet easily secures its S-tier status thanks to an unbelievable combination of growth, valuation, and just sheer optionality. Sitting on a market cap over $4 trillion, they're boasting robust 37% EPS growth. Their Gemini models, Google Cloud AI, and AI-enhanced search are delivering absolutely massive results. Plus, internally, their custom silicon, like their TPUs, their in-house chips, aggressively drives down their own compute costs. Among the major hyperscalers, this might genuinely be the best risk-reward play out there right now. Rounding out our elite plays, we have to talk about the critical infrastructure providers, Broadcom and TSMC. Broadcom is watching their AI revenue literally double, backed by a massive order backlog for their networking gear and custom AI accelerators. Meanwhile, TSMC is the undisputed foundry kingpin. They're the ones physically building the chips. Everyone else's grand AI visions completely rely on TSMC's advanced manufacturing nodes to even exist. With 30% plus growth guidance and a healthy dividend, both of these are offering stellar margins and really solid capital returns.
All right, Section 3, A tier, strong contenders. These are fantastic plays where we have high conviction, but they do come with a few caveats.
Let's look at Meta first. They are utilizing AI incredibly well to drive ad efficiency across their massive user base, and they're trading at a very reasonable 20x valuation. But the caveat? They battle immense capex intensity. They have to spend staggering amounts of cash up front just to build these models. On the flip side, we have AMD. They're a really solid alternative to NVIDIA and are steadily growing their data center share. However, they face intense execution risks and generally carry a valuation premium when you compare them directly against the undisputed market leader. So, fantastic companies, just with slightly higher hurdles to clear.
Section 4, the B tier. These are solid stocks that are definitely worth watching, but you need to monitor them closely.
In the B tier, we find big names like Palantir and Amazon. Now, Palantir boasts incredible growth in government and enterprise contracts through their AI platform. But that elevated valuation and high beta, which means the stock price swings a lot more violently than the overall market, means they have to execute flawlessly. Any slight miss will be heavily punished. Then there's Amazon. AWS is an absolute powerhouse, no doubt about it. But because their overarching business is so heavily diversified with retail and logistics, they just offer slightly slower, pure-play AI visibility compared to a Microsoft or Google. Solid picks for sure, but keep a close eye on those specific metrics.
Section 5, the avoid tier. This is where you really need to proceed with extreme caution.
The most crucial takeaway here is to beware of the hype. Just because a company slaps AI on its press release doesn't make it a smart buy. Take Intel. Despite having some AI exposure, they are actively struggling with really high execution risk, massive competition, and a highly uncertain turnaround story. Furthermore, you need to be deeply wary of small to mid-cap software stocks claiming to be pure-play AI. Many of them are trading at sky-high multiples but completely lack the defensible moats or proven scalability you need for long-term survival. Avoid these overhyped names if they don't have a clear path to profitability.
Honestly, if there's one golden rule to remember from all of this, it's this quote right here. The future belongs to those who own the picks, shovels, and platforms powering AI. Don't chase memes, own quality with durable advantages. The hyperscaler supply chain, the guys actually building the physical and digital infrastructure, is just a significantly safer, much more lucrative bet than chasing speculative, unproven software multiples.
Section 6, Winning AI Portfolio Strategy. Let's break down how to actually build a winning approach.
Here is exactly how you can apply this tier list to your own 2026 investment strategy. Step 1. Establish your core allocation. You really want to lean heavily into the S tier. Let NVIDIA, Microsoft, Alphabet, Broadcom, and TSMC form the absolute bedrock of your AI exposure. Step 2. Diversify. Carefully sprinkle in some A-tier stocks like Meta or AMD to balance out the portfolio and capture different angles of the market. And Step 3. Manage volatility. This sector moves fast, so utilize dollar-cost averaging, meaning buy a little bit at a time over a set schedule to smooth out those price bumps. Doing this transforms you from a passive watcher into a truly informed strategist.
As we wrap up today's explainer, I want to turn the floor over to you. Learning is a shared process, right? So I want you to think about your own thesis based on the metrics we covered, looking at the growth, the moats, and that massive shift to inference compute. Drop your thoughts in the comments below. What tier would you truly put NVIDIA in for the next 3 years? Thanks so much for joining me on the explainer today. Keep learning, stay focused, and I'll catch you in the next one.